All right, we're going to go ahead and get started. I am, again, Jesse Hurs, for those of you who don't know me, certified financial planner, president and founding partner here at Impel Wealth Management. We're very happy that you joined us for today's webinar, which is entitled, it's our second quarter outlook, entitled Preparing to Land, right? So you've heard a lot of talk, and we're going to reference this a few times throughout today's webinar, a lot of talk about hard landings, soft landings, or no landings for the economy, for corporate earnings, and what happens with the stock market. So we're going to land somewhere, and hopefully by the time we get through today's webinar, you'll have a little better feel for where we go with that. So joining me, well, first of all, I'm going to pop in here and give you a little bit of background bio for each Nathan and myself, right? So Nathan and I are both certified financial planners, specialize in providing customized solutions for those aspiring to make a successful transition from work life to a meaningful retirement. So I've been doing this since 1987, since actually started in the business about 6 weeks before the stock market crash of 1987. Real interesting time to join and start in the business, but primarily focus on helping people make that successful transition from work life to retirement life, and really focus on areas of retirement income planning, estate planning, and investment portfolio management. Nathan, I'll let you introduce yourself here and share a little bit about your background.
Sure. Yeah, I'm Nathan Olli. As Jess said, I'm a certified financial planner here at Impel Wealth Management. And I don't have quite as much experience of Jesse, but I'm actually celebrating my 10 years in the business after serving as an Army officer. I started in 2013, coming out of active duty as an Army officer. And, my focus is a lot on the retirement income and investment management side of it, but also helping those that are still younger, excuse me, in the accumulation phase of life, focus on how to make smart financial decisions, wise choices, utilizing their group benefits appropriately, and really making sure that they're getting off to a good start as they're starting their own financial journey. So,
right, we always kind of take a look at the wealth management process as a combination of investment consulting, advanced planning, and relationship management, right? And Nathan referenced it just a minute ago, right? We want to help clients address their key financial concerns, which is making smart decisions about their money, mitigating their taxes, taking care of their heirs, and magnifying their charitable gifts. And that's really what we try to help clients get across the finish line and do. So with no further ado, we'll jump right into our agenda today. We'll probably spend 20, 25, 30 minutes, depending on how many stories Nathan, and probably more so myself, tell, and along the way to give you some background on this. At the end, please, if you have questions, please write them down. There's a Q&A button. Don't hit the chat button at the bottom. Hit the Q, or it's either at the very top or the very bottom of your screen. There's a toolbar there. But if you have questions, hit the Q&A, type in your question, and then Nathan will be facilitating those questions with us as we get toward the end. We'll remind you a couple times as we go through here. So with that, what we're going to focus on during our second quarter outlook is kind of this, what we look at as a chain reaction, right? We start off on the left side with what's going on with inflation, right? And inflation, it's funny, Nathan and I were presenting a retirement plan projection to a client not long ago. And for the last 20 years, we've used a 3% rate of inflation as kind of the baseline target for inflation in those retirement plans. And prior to 2 years ago, for the most part, clients would ask us, why are you using a rate of inflation that's so high? We haven't seen inflation above 2% in 15 years. Now, for the first time in a long time, we have clients going, why are you using an inflation rate that's so low? So low as we think about inflation, getting close to double digits last year at 9.1%, falling back to 5% more recently. But we know things start with what's going to happen with inflation, because that will ultimately drive what the Federal Reserve Bank does. and whether the Fed's going to continue to raise rates, especially in light of recent banking disruptions and volatility that we've seen. We'll talk a little more about that. And then if the Fed continues to raise, or when they pause, how long will it be until they start cutting rates? And what does that mean for the stock market, the bond market, and ultimately for the economy and where we land? So those are the things we're going to start and cover during today's session. We're going to start off by talking about inflation. So if you think about it, inflation is slowing, right? But it's still high. And you can see from this chart that goes back, all the way to the early 80s, you can see those high inflation rates of the late 70s, early 80s, when Paul Volcker, who was the Federal Reserve Bank chairman at the time, raised the Fed funds rate to 20% and to kind of squelch inflation. And inflation by the mid 80s had fallen back down in this 2 to 4% range. And for the most part, other than a spike around the first Persian Gulf War, which was primarily driven by higher oil prices because of uncertainty in the Middle East, you can see that for the better part of the next 20 years, inflation just kind of moderated between 2% and 4% for the most part. And we had a little bit of a bump up towards the end of the dot-com bubble here, right before Y2K and the turn of the millennium here in 2000. We had another little spike up right here towards the end of the real estate bubble before we went into the subprime mortgage crisis. And then subsequently, inflation from 07-08 pretty much remained in this 2%-ish range, a couple of times falling down, close to zero. And it's really in this post-COVID scenario that we saw inflation spike, right? If you think about it, today, and I know this chart's a month old, there's been another inflation release since then. The April CPI report, which showed inflation in March, showed inflation fall another 1%. It dropped from 6% to 5.0%. The month-over-month headline number was only up 0.1%. However, core inflation, which we'll talk about here in just a minute, continues to rise, and services inflation continues to rise. But if you think about it for perspective, if you see inflation at 5% today, people will go, oh, inflation's come down from 9% to 5%. But if you think about it from 3 years ago, people would think, oh, inflation's horribly high at 5% where it is today. And we personally think that inflation, one of the things, and I'll try not to get too complicated here, but if you think about inflation, when this number comes out each month at 6% or last month at 5%, that's looking back over the last 12 months. And while we don't know exactly what inflation will do in the future, we know what inflation did in April, May, June, July of last year. So we know what months will be dropping off. And based on some of those high base effect months, we think that inflation will likely fall down into this 4%-ish range. Probably by midsummer, June, July, August, we'll be down in this 4%, maybe 4.5% range. The big question is what happens next over time? We're still seeing some issues with what's known as sticky inflation, which are things like wages, service inflation, and especially housing. So, this chart takes it to the next point. This PCE, most people are familiar with CPI, or Consumer Price Index inflation. And Consumer Price Index inflation is what you get from the Bureau of Labor Statistics every month. PCE is what the Fed follows. And this chart breaks it down into two separate sections. The purple line is the goods. This is manufactured goods inflation. And then the blue line is services inflation. So you can see services dropped here at the beginning of COVID. This is the big recession when COVID happened here, and we shut everything down early in 2020. Manufactured goods inflation dropped as well. But once we started sending out stimulus checks, once we started sending out PPP checks and enhanced unemployment checks, all of a sudden people had money to spend. And since they couldn't spend them on services, they couldn't eat out, they couldn't go to the hair salon, they couldn't go to the movies, they couldn't get on an airplane and travel anywhere. All that money went towards the good side of the economy and shot inflation on the good side up dramatically. And now, and you can see there's the first spike. Here's, then we see another spike with the last stimulus checks. And now that has fallen back down. But once we reopen the economy, once people could start eating out again, traveling again, going to the movie theaters again, you can see that services inflation is rising, and it has not started to fall back yet, which is something that we are watching very closely. The next PCE inflation release from the Fed is actually this Friday, April 28th, which the reason that's so important is next week, the Fed meets again. The Fed meets again on Tuesday and Wednesday next week. It's a week from today at 2 p.m. The Fed will announce their next decision on whether they're going to raise interest rates again, or whether interest rates, whether they'll potentially pause. So when you think about it, one of the things we're watching is that sometimes in this environment, good news can become bad news and bad news can become good news. And what I mean by that is, think about this morning. This morning at 8:30, they released the durable goods orders for big, heavy manufactured items, generally that are supposed to last 3 years or longer. So when they released this last month, durable goods orders fell 1.2%, which would suggest that the economy was slowing. And they expected it to be up less than 1% this month. And it actually came in at 3.2% this month. Well, that sounds like good news, but it means that maybe there's more strength in the economy than we expect. And if there's more strength in the economy, what that means is the Fed may need to keep raising interest rates, which could be bad news for stocks and bonds. So conversely, when we've seen some things happen where you've seen economic data slowing, inflation slowing, weekly jobless claims have been rising. Those are all things that point towards a slower economy, which may mean the Fed doesn't have to raise interest rates as much in the future, which can be good news for stocks and bonds. So it's a little confusing, but it seems like kind of where things are heading. And then this is something now nobody outside the financial world really has ever seen this, but 4 times a year, the 12 Federal Reserve Bank governors and all the Federal Reserve Bank presidents release their economic forecasts, and each of the Fed governors put in a dot where they think inflation's going to be, where interest rates will be, GDP growth and unemployment. And when you look at the combination of all the Fed governors and presidents, each one of these dots represents them, and it's known as the Fed dot plot. And it's showing that at the end of 2023, we are expecting, or the Fed is telling us, that their average view is that federal funds rates, which right now today are in a range of 4.75 to 5%, will still be between 5 and 5.25%, even at the end of 2023. Now, the interesting thing about that is, and then they show that as we move into the future years here, by the time you get to the end of 2024, they expect that's going to be down about 1%. And by the time you get to the end of 2025, it'll be down to about 3%. But they're showing that the Fed's going to raise interest rates one more time, most likely next week. And they're telling us that they're not going to cut interest rates at all between now and over the next 8 months, between now and the end of the year. The market isn't buying it. And there's a reason for that, right? The Fed puts out these projections. The Fed meets 8 times a year, 4 times a year, they put out these projections. And the reason that's important is, you have to understand, looking back on it historically, how off the Fed has been in these projections. So in December of 2021, 16, 17 months ago, the Fed put out one of these dot plot projections where they projected that for calendar year 2022, last year, they projected that they were going to raise interest rates 3 times, and they projected that they were going to raise interest rates a total of 1%. Well, the Fed ended up raising 7 times. They raised interest rates 7.25%. I'm sorry, 4.25% over those 7 times. So they weren't even close to what they projected they were going to be. And I've written a lot about this in our blog posts, and I've listened to a number of economists, most notably Jeff Gundlach of DoubleLine, who has literally come out and said, I don't know why we're paying 400 PhD economists at the Federal Reserve Bank $35 million a year of salary to be that wrong. And so this is what the Fed's telling us. But what the market is telling us is this: the Fed, you can see here that the Fed funds rates priced in by the Fed funds futures are telling us that they believe by the end of the year that the Fed will have to cut interest rates from 5% back to 4%. They're projecting at least 2 to as many as 4 interest rate reductions to deal with the potential of an upcoming recession. Now, the other thing that you didn't see a lot of news about, you had to get really deep in the financial news weeds, was that in the last Fed dot plot, they actually projected that GDP would contract between now and the end of the year, and that we would have a recession. They didn't really say that out loud. You kind of had to impute it from the numbers. But you see that this drop in projected interest rates really came about in March of this year. Well, what happened in March of this year was we saw, as interest rates run up, we've talked about this a bunch in the past, when interest rates go up, bond prices go down. And so banks who invest a lot of their excess capital and their reserves in government bonds and mortgage bonds, as the Fed raised interest rates, the value of those bank reserves that were invested in those went down. And that in part led to the failure of Silicon Valley Bank, Signature Bank, and it's putting pressure on First Republic Bank right now. So you saw those interest rates. You can see from the day that SVP announced that they were struggling with capital requirements, you can see those interest rates fell almost off a cliff. 2-year treasuries went from 5.06 to below 4 in 3 days. Now, to put that in perspective, that's more than a 20% drop in interest rates. In, going from 5 to 4 is more than a 20% drop in interest rates in 3 days. If somebody told you the stock market dropped more than 20% in 3 days, people wouldn't believe it, or people would be, panicked about it. But we saw interest rates move like that in a 3-day period. The last time 2-year treasuries moved that much in a 3-day period of time was in October of 1987, just before the Black Monday stock market crash. So with that, with that happy piece of news, we're going to turn it over to Nathan, who is going to talk about landings, right? He's going to talk about hard landings, soft landings, no landings, but hopefully by the time he finishes, he will have stuck the landing with this. So,
there you go.
There you go, Nathan.
Yeah. So thanks, Jess. So, what does all of that mean? We're talking about what the Fed is going to do in terms of interest rate potential cuts and all of that. And if you paid attention to the news at all, then you maybe heard some people on TV, some of the prognosticators or, talking heads talking about, what type of landing are we going to have, right? And Jess alluded to it. Are we going to have a hard landing? Are we going to have a soft landing? Or there's even talk of, are we going to have no landing, or kind of this idea of a rolling recession? And what does that all really mean? Well, when we talk about a hard landing, that's a deep recession, right? That would be the rails really came off and we really went through a deep recession for the economy. A soft landing would be a much more mild recession, and the no landing or the rolling recession would be either we don't have a recession at all, or if we do, it's only going to kind of roll through the economy at different parts. Different sectors of the economy are going to be impacted either at different times with different levels of severity, or maybe a combination thereof. And we would say that our thesis overall would be the middle. We think that we're likely going to have a potential for a mild recession in the second half of the year. And on the next slide, and the slides coming, I'll talk about maybe why we think that is. So when we look at this next slide, this chart book is put together by our friend Gene Goldman and his team with Cetera Investment Management. And when we look at this is a look at 10 different forward-looking economic indicators, and they show kind of two different things. They show, is the current risk of recession, is it in the green, the yellow, or the red, right? Is everything okay, or are we in the negative? And you can see by looking here that it's high, right? And that's based off of looking at some of those indicators, things like the manufacturing PMI and building permits for new homes and the index of leading economic indicators. All of those things are saying that there's a high risk of recession right now. And the other key thing to look at here is the trend. So that trend box over on the right shows the last 12 months of those readings. And as you look from left to right and read that, as those numbers are trending downward, some of them going from positive to negative, or maybe from just if you look at the manufacturing PMI there on the top, numbers above 50 are expansionary. Numbers below 50 are when you're in contracting or indicating a recession. So you can see there, 12 months ago, 57 was showing expansion, but we're sitting at 47 today. So the trend is negative. So when we look at this is one of the main reasons why we really think we're likely headed towards a recession. And so if we move on into our next slide, then we'll talk a little bit about what's going on in this slide. But before I get into that, Jesse alluded to it there when we talked about one of the big elephants in the room recently, which has been what's been going on in the banking sector, which we saw obviously some banks go through quite a bit of stress here just recently in the last month, couple months here, and some are still going through it. However, we think that that's largely being contained, as a lot of those banks, just talked about them. They're more niche banks, right? They're really focused on startup companies, venture capital companies, a very unique depositor base from some of your larger, more established banks. And those companies, or those banks, that cater to those types of companies, when you're overexposed there, those types of venture companies or venture capital firms or startup companies, they need low interest rates to help drive their profits. And when the Fed raised interest rates so aggressively last year, it became much more difficult for those venture capital companies to borrow. And when they could borrow, they were having to borrow at much more expensive interest rates. And capital just dried up. And when capital dried up, you started to see a run on some of those banks on the deposits. And the other key thing, not to get too technical, is when Jess talked about, remember, a lot of those banks, they have to have certain percentages of their assets are held in long-dated treasury bonds. And when they held those long-dated treasury bonds, when interest rates went up, the value of those long-dated treasury bonds fell. And when they had to sell some of those bonds in order to raise capital for these depositors who were coming in asking for their money, well, they had to sell those bonds at a pretty steep loss, which is part of what caused the issues. Now, we think this was largely due to, maybe a little bit of mismanagement on these banks. Were largely contained by those banks. You saw some of the larger, more well-established banking names come in to kind of help the Federal Reserve in terms of, backstopping some of this. So we don't think it's going to necessarily spill over into the banks. Yeah. But, overall.
Nathan, do you mind if I take a minute and just kind of share kind of the SVP story, just because it's so unusual? Because we got, over the last 3-4 weeks, we had a lot of clients ask questions about, should I be concerned? And is this like an 07, 08, potential contagion scenario? Back in 07, 08, we saw all kinds of speculative lending, speculative building, and we saw banks across the country kind of load up on these subprime mortgages and then leverage up their balance sheets using them, which worked great until it didn't. And by the way, while I'm telling this story real quick, let me remind everybody that that if you have questions about this or any topic, just click the Q&A button and type the questions in, and we'll address those here in the next 10 or 15 minutes when we finish our presentation. But if you take a look at a typical regional bank, a typical national bank, they have millions and millions of depositors out there. And by and large, most of those depositors, outside of some large corporate accounts, have less than $250,000 in there, which means they're covered by FDIC insurance. So for those people, nobody's worried about whether or not the bank's okay because they've got FDIC insurance. Silicon Valley Bank in particular ran into this scenario, right? They, instead of having millions and millions of depositors, because they were primarily venture capital, private equity, and IT startups, they only had about 40,000 depositors, and their average account balance, from statistics we've seen, was something north of $4 million, and something north of 90% of all the deposits they had on at that time were more than the $250,000 FDIC insurance limit. So this is the scenario I've been trying to play out with clients who ask the question is if you're the treasurer or CFO of a mid-sized company and you've got $5 million in your payroll account to cover your payroll for your 500 employees for the next several months, and you hear that the bank's having problems and that they're having problems with raising capital and problems with liquidity and possibly solvency, how long are you going to keep your money in that bank if you're the CFO? Well, you're going to get your money out of Dodge as quickly as possible. And between the time on March 8th, when they made that announcement after hours on Wednesday, March 8th, over the next day, that bank, which had over $210 billion of assets, had withdrawal requests in the next 24 hours for $42 billion of withdrawals, which, going back to Nathan's point, they had to sell collateral. And do you remember what the numbers were on that, Nathan?
I know they took a $1.4 billion loss on
just selling bonds, selling government bonds and mortgages, which are typically deemed as a relatively high quality asset. But because interest rates had gone up, the value of those bonds and mortgages had gone down. So just to meet withdrawal requests, they had to take a huge hit to their balance sheet. And they had requests for more than $100 billion of withdrawals for the following day on Friday, when the FDIC came in and shut them down. My point to all of that is not typical to the rest of the banking system. When you have banks with millions and millions of depositors who largely have less than FDIC limits in their bank accounts, that is not something that we expect to see replicate like we saw subprime replicate, in 2007, 2008.
Yeah.
Sorry to jump in there, Nathan, but I just wanted to share that story with people.
Yeah. So if we go back, the one thing that we are seeing is on this chart, one of the things that it shows here is this is a chart showing, kind of different lending standards, whether it's commercial loans, consumer loans for things like autos, home loans, small business loans. What we're seeing here is that the lending standards are getting tighter. And actually, it was interesting at Jerome Powell, the chairman of the Federal Reserve Bank, at his last press conference actually alluded to this and said, hey, if lending standards are getting tighter, this in and of itself could potentially act as a rate cut. And, with the reason being that if it's harder for you as a consumer to go get a car loan or a home equity line of credit or what have you, that's that's tighter financial conditions. You may not have the capital or the money to go do what you want to do, which will then slow down economic growth. And if we see economic growth slowing down, that may give the Fed, reason to pause or to think about, stopping raising interest rates. But so in and of itself, tightening lending standings could act as another potential, as a rate cut here. So when we look at the next slide, which talks specifically about whether or not we're going to go into a recession in 2023. One thing that we would point out is the recession is not necessarily guaranteed here. Now, I already hinted there's a lot of indicators that say we are headed there. But one of the things that this chart shows, this is from what's called the Atlanta Fed GDP Now, where they do relatively real-time estimates of where they think GDP growth is going to be. And remember, if GDP growth is positive, well, then typically, you don't have a recession. So this chart, which was from March 16th, so it's about a month old now, showed that in the first quarter of 2023, they were estimating that GDP growth was going to be just over 3%. Now, I will say, one of the issues with having to prepare these in advance and get compliance to approve slides and all those types of things, that the actual number, the new number for this came out yesterday, which is now at 1.1%. However, what's interesting about that to note is that's still actually expansionary. It's not a negative number. 1.1% growth in the quarter is still, it's still above zero. So it's still an expansionary number, which actually, though, we think that's part of what shows our thesis of why the economy is definitely slowing, but we don't think we're on the brink of a recession right now. You may see one in the second half of the year, but not imminent, not right this second. So let's talk for a second, though, when we talked about the landings, what's one of the cases for a hard landing? So this chart is an interesting chart. It's called the 16% trimmed mean CPI. And what does all that fancy language mean? That's where essentially you're taking out the top 8% of the categories that impact inflation and the bottom 8%. And instead, you're focusing on just what's in the middle. We got to remember that inflation in general is broad-based. And when you look at this chart, you can actually see that since the pandemic, we are running at much higher rates of inflation overall. And even though it did come down some, it has actually gone back up a little bit here. So what does this show? This shows a potential of what could be a bear case. Why? Because it shows that maybe the Fed doesn't quite have inflation under control as much as they think they do. This may mean that if inflation is going to stay relatively elevated from a historical standpoint, that they may actually have to raise rates higher than what the market is currently pricing in an attempt to get inflation further under control. If inflation from a broad-based perspective, which is what this is showing, if we trim out the kind of the high highs and the low lows, from a broader perspective is still higher than historical norms, maybe the bear case is the Fed has to keep raising rates to try to bring that level under control. And that's what this chart is showing. Now, that's not necessarily what we think our base case is. The next chart, which is talking about a soft landing, really speaks a little bit more to where we think. And what this chart is this is the ISM manufacturing PMI. And you can see there on the far right where it's at 47.7. Remember, I talked anything below 50 is contraction. Anything above 50 shows expansion. So you can actually see it's already in contraction phase right now, but not terrible, not horribly so, not nearly as deep as, that's right, some of the other, the 07, 08 financial crisis, the dot-com, 9/11, or even during COVID. So, and just for, so what the survey really shows, what the manufacturing PMI survey is it's where they go out and they survey managers in the manufacturing sector specifically and say, hey, what are your thoughts? What are your thoughts on future hiring for your company? Or are you going to have to be letting employees go? What are your thoughts on, are you guys going to be having to build up more inventory? Are you expanding your operations? And that's what this is showing. So it gives us a really good gauge of where the manufacturing index is going. One of the things that you can see is it's a contraction, but it's a mild contraction compared to what we've seen in the past, which is why we kind of lean back on our base case of we think it might be a more mild recession. And the last thing I'll say about it is you can see from 2020 when the stimulus money came in, when the CARES Act passed, the manufacturing industry was really the first industry to really benefit. Big boom there in manufacturing growth. Now it's come back the other way, which is to be a little bit expected, but still not as deep as previous recessions, and that's part of the reason why we think we're not as deep a pullback as previous contractions in manufacturing, which is why we think we're likely headed towards a more mild recession.
Hey, Nathan, what do you think about this manufacturing side pulling back? When you think about the two sides of it, you've got demand, whether demand is weakening from the consumer side or whether, they've just built up enough inventory now that they're not having to manufacture as much. Any thoughts around that?
Yeah, I mean, one of the things that we're seeing is I think it's a lot of it might be from buildup of inventory. We kind of had a lot of plants obviously had to shut down initially during COVID, but then once they were able to reopen, they really saw an increase in their productivity level, which is shown on this chart. But now think about when Jess was talking earlier about durable goods. Well, if you're a manufacturing company that makes kitchen appliances, and all of a sudden there's this huge demand for the appliances because consumers, they couldn't spend money on services. So instead they remodeled their kitchens, right? They couldn't go out to eat or they couldn't travel. So they remodeled their kitchen. Huge demand. So manufacturing ramped up to meet that demand and pricing went up as well as a result of that. But if you remodeled your kitchen 2 years ago, you're not necessarily buying new kitchen appliances today. So part of that has led to a buildup in inventory and some of that, which is part of what we're seeing on the contraction, there is that buildup of inventory is people already spent it, right? They bought their new washer and dryer or their new refrigerator. Now they don't need it. So we're having a buildup of inventory there on the manufacturing side.
And nobody's sending them any additional stimulus checks.
That's right. Yeah, no free money coming anymore either. Yeah. So on the next chart, which is kind of the Goldilocks, chart, so to speak, which is really a no landing or that rolling recession. What this is really showing is, are we going to have different sections of the economy? We already talked about manufacturing being in contraction, but are there going to be other sectors that maybe either avoid a recession altogether? Maybe they enter at different times. And if that were to happen, you could see the broad-based economy in general potentially avoid a recession. And the strongest argument for that would be with this chart here, which is showing the strength of the labor market. So when you look at the blue line, that's the number of unemployed people who are looking for work. And the purple line is the number of jobs that are currently available. And right now, there's still more than 10 million jobs available and just over 5 million unemployed people looking for work. So it's nearly a 2-to-1 ratio. And why is that kind of the Goldilocks or the bull scenario? Remember, most of our economy is driven by consumer spending. And when people have a job or they don't fear losing their job because they can just go get another one because there's more jobs available than there are people looking for it, well, then people tend to feel pretty good and they go and spend money. And if they're spending the money that they have from their paychecks, well, then that's what can potentially keep our economy out of a recession. The one argument that I would make before I turn things back over to Jess here is I would note that if you look at the blue line that focuses on unemployment, you can kind of see that over this is a chart going back over 20 years. When unemployment the numbers go over a long period of time, and then when there's a crisis, they shoot up very, very quickly, very dramatically. So the one thing that we got to be cautious of is, although the labor market looks pretty good right now, if we were to see some things slow down, other areas of the economy, you could definitely see on the unemployment number tick up relatively quickly. You could see the jobs available number come down relatively quickly. Now, we don't necessarily think that that's going to happen like it did back in 2020. And the good thing is we're actually kind of starting at a good spot, right? This is a pretty strong spot to be in, which is why we still think there's likely a mild recession that's coming, but not maybe as dramatic or as drastic as what we've seen in past ones.
So, and the other side of this, right, is that this dynamic where there's more jobs available than there are workers to fill them is part of what concerns the Fed, because it's causing, it allows potential employees to negotiate higher salaries, which adds to wage inflation, right? And that's part of that sticky core inflation that the Fed's trying to manage. So all of that leads to uncertainty, right? You sit there and you think about it and you go, we got a lot of uncertainty out there. We've got uncertainty around what the Fed's going to do, where inflation's going to go. We've got some uncertainty in the banking sector. We'll talk here in just a minute about corporate earnings and what they're going to do. We've got uncertainty around whether or not we're going to end up in a recession and how deep it will be. And then you throw in some of the political stuff, right? We've got the debt ceiling hanging out there. We've got, by this time next year, we'll be way deep into the presidential and congressional election cycles, which I'm sure everybody is excited to see. So I'm being very facetious there. So anyway, so let's talk about a few things that are adding to uncertainty. Number one is China. China has finally relaxed or dropped most of its COVID mandates, which I actually have a client that lives and works part of the year in China, who kind of gave us on the ground reports there from time to time. And when you looked at what was going on over there, everything was shut down. Well, we know what happened in the United States when we reopened. It caused a surge in demand. People started eating out again, traveling again, going to movies, doing things, and going to sporting events and so forth. And we think something very similar could happen in China. As a matter of fact, earlier this week, we saw China first quarter GDP came out above expectations. So, while that sounds good and it could help keep the global economy, not the US economy, but the global economy maybe from going into as deep a recession, it could also put inflation pressures by putting demands on goods, demands on manufacturing. And most importantly, as people in 1.3 billion people in China start moving around again, it could put demand on energy prices, oil and gas prices, because if all of a sudden, right, OPEC cut their oil production targets by a fair amount, more than 1 million barrels a day, in the last 30 days. So if OPEC's taking supply off the market at the same time China's ramping up demand, that could add to inflation pressures from energy. And then we also have geopolitical tensions with China, right? We've got all kinds of stuff going on in the IT industries. You've got trade wars going on between China and the US, and then you've got China's backing of Russia. So there's a lot of issues going on with China that could add to uncertainty, right? The next thing we have is the stock market, right? So Nathan talked a little bit about valuations before, right? This is a 5-year, not quite 5-year, 4-year chart of the stock market going back through 2019. Here you see the big drop when COVID hit in February, March, 6-week drop where the stock market measured by the S&P 500 dropped 34%. Then the CARES Act and the Fed opened up the floodgates of liquidity and the market rebounded, hit its all-time peak on January 3rd last year. Intraday, it got as high as 48.18. And in mid-October last year, briefly dipped below 3,500. So the interesting thing is if we look at where the market is today, a lot of people are surprised to see that from mid-October to where we are today, the market's up 15, 16% off its October bottom. But while we saw the market drop in kind of three swooshes last year, the first one was when the Fed reversed course and Russia invaded Ukraine. Then we had a combination of higher energy prices, higher food prices, COVID lockdowns in Shanghai, China, the world's second largest shipping port, and then inflation numbers, CPI numbers, really starting to jump up, which caused the Fed to raise interest rates 0.75%. We saw a little bit of a relief rally in July, August, and then a third swoosh down as the Fed came out. As a matter of fact, this day here, where the market peaked in mid-August, Nathan and I and our investment committee were actually meeting in Dallas that day when Jay Powell came out at the Federal Reserve Bank Symposium and said, hey, the Fed is nowhere near done cutting interest rates. We're going to continue to raise interest rates aggressively. And the market took another swoosh down. So as you think about it, there's a terminology that we use in the markets called PE, or price earnings ratio. It's the price of the stock market compared to the corporate earnings that these companies are earning. And we're actually in the midst of first quarter earnings season right now. And part of what we look for in earnings is, what are they saying about what did happen in the last quarter, but what are they projecting is going to happen in future quarters? But last year, most of this drop came from a drop in the P, the price of the stock market, as the Fed raised interest rates 7 times. What we don't think we've really seen taken into account in a big way yet is whether or not we're going to see, or whether we have seen priced into the market, whether earnings are going to drop because of a projected recession. Historically, they do. And when you think about it, this is year over year, quarter by quarter earnings growth, right? It's year over year. So this is comparing the first quarter of 2021 to the first quarter of 2020, right? This one's pretty easy because when you compare April, May, June of 20 to April, May, June of 21, April, May, June of 20, the entire economy was shut down because of COVID. So the following year, things rebounded. But you can see those earnings growth rates are slowing. And now we saw that in the fourth quarter, earnings fell, and they're projected to fall 6% this quarter, almost 4% next quarter, before they start to bounce up. But the really important thing to remember, and let me see if I can do this. Let me go back. All right, if we go back here, is that historically, the stock market, which is a leading economic indicator, starts falling before a recession, and then the stock market starts moving up before the recession is over. You know, the market bottomed in March of 2009 after the 2008-09 financial crisis. And if you think about it, in March of 2009, the news was awful. The stock market at that point was down 57%. And when the news was awful and the stock market was down horribly, all of a sudden the stock market started going up, and the recession didn't really end until 3 or 4 months later. So trying to time this based on a shallow earnings recession, you know, when the market's still down, 16, 17% from where its peak was, going back here, we're still 16% or so off that peak today. And we think the recession and the earnings recession could be relatively mild and could lead to a decent bounce in earnings heading into late this year, early next year. So last thing we're going to touch, and then we're going to head into Q&A. And again, if you have questions, I see 3 or 4 in the queue. We're going to answer those in just a moment. But let's talk about the bond market. So this is interest rates on 10-year treasuries, which don't exactly, remember, the 10-year treasuries are controlled by the bond market. The Federal Reserve Bank controls short-term interest rates. The bond market controls these. But you can see, interest rates on 10-year treasuries got below 1% back during the days of COVID. and got above 4% last fall, nearly 4.25% late last year. So as interest rates went up and bond prices went down, the bond market had its worst year last year since 1920. The bond market lost 13%, measured by the AGG, the long-term bond index, lost 13% last year. In the last 100 years, the next worst year in the bond market was in 1994. I remember it well. The Fed raised interest rates 6 times at that point, and the bond market, in a year where the Fed raised interest rates 6 times in 1994, lost 3%. Last year, it lost 4 times that amount because of how quickly and how dramatically the Fed raised rates. So if you think about the bond market, Nathan and I have had a lot of clients come to us and say, geez, the bond part of my portfolio did lousy last year. Shouldn't I be getting out of it? And it's kind of like, we always use the analogy that managing a portfolio is like driving a car, right? If your portfolio is the car, if you're looking through the rear view mirror of how the bond market did last year, it looks awful, the worst since 1920. But if you're looking through the windshield of what's coming economically, with interest rates much higher today, and the fact that if at some point down the road we hit recession and the Fed has to start cutting interest rates, then you get a higher yield plus appreciation. And we think the bond market is set up to do as well in the next couple of years as maybe as what we've seen in as good a setup as we've seen in maybe 12, 15 years. So we want to make sure that people continue to stay diversified, continue to seek out help from your advisor. That's what we're here for. We're here to answer questions. And, there's a number of things we can do to help you, right? We have our weekly blog posts, right? The cornerstone of what we do is financial planning, right? Every decision you make about your finances and your investment portfolio should be driven by, does it help me accomplish my overall financial objectives? And with that, we're going to go to Q&A. So Nathan, if you want to kind of start with Q&A, what we've got, tell me where we're at.
Sure. So first one, I think we can handle pretty quickly. It says, is Impel taking new clients? And if so, how much is an initial consultation?
I love those questions. So yes, we are open for business. It's why our team continues to grow, right? Nathan, when we opened the doors, as a matter of fact, it was 6 years ago this week that we moved into the building on 4th Street in Cuyahoga Falls. And at that point in time, it was me, Karen, Sarah, and Marie, and our clients that came with us from our previous firm. And now there's 8 of us and a college intern, and we continue to grow. And part of that is Nathan joined us. It'll be 5 years in June. Mm-hmm. So Nathan's coming up on his 5-year anniversary, and that allowed us to help and serve more clients. Irene joined us almost 18 months ago. She's coming up on 1.5 years. And that allows us to take our systems, which are scalable and replicable, and help many more client families. So yes, we're open for business. If you go to our website and look under the services tab, there's something there called a second opinion service for people who are going, I'm not sure where I'm at and I need to get a second opinion. You can fill out a form there or refer friends and neighbors there, but there's no charge for an initial consultation. Once we get through an initial consultation and we decide, what the client needs and how we can best help them, then we talk about what financial planning fees or investment portfolio management fees there would be.
Yeah, great. Thanks, Jess. The next one is, with all the speculation out there, how do we discern between fact and fiction, and when should we call you to talk about it?
Yeah, that's a great question. And you think about it from there's a lot of news and noise, right? And, as we head into political season, you're hearing people on both sides of the aisle say that's fake news or this is fake news. And just because something's on the internet doesn't make it true, right? So in general, if you have a question about something specific that you've heard and it's giving you angst or it's causing you to question either your investment portfolio or philosophy or your financial plan, we encourage clients to call us. We would always rather have a client call us, ask a question, than to make either an ill-informed or emotional decision about a bad piece of information or a piece of information that they got online that may or may not be applicable to their situation.
Yeah, the only caveat, the only thing maybe I'll add to that too is, I think, especially as it pertains to things that we can click on the internet, how do those companies make their money? They make their money based off of advertising, and if they can get you to stay on their website and keep clicking through, then they make their money. And so they don't really have much in the way of an incentive for you to be financially successful, right? So and that's I don't care, both sides of the aisle. If they can get you to just keep clicking through, that's what they want. So there's no real, they're not necessarily going to feed you things that would help you make wise financial choices. They just want you to keep clicking on their website and staying there, So I think that's
and if you think about it from that side, it leads to sensationalistic headlines that cause people to get emotional and click the headline, whether that's what the underlying article is about or not.
Yeah, that's right. So
one more. I think we have time for one more question before we jump off here.
Last one anyways is where do you think tax rates are going?
Oh, so this is one of my favorite things to talk about. We just got updated tax information for the most recent calendar year that it's available from the IRS just in the last month here from the Tax Institute, and we'll be sharing some of that information with you. It's always interesting trying to share data about taxes with clients without it sounding political one way or the other, right? Because your goal is to inform and let people make their decisions from that standpoint. So here's the thing I think we got to really keep an eye on. In December of 2017, the Tax Cuts and Jobs Act was passed. It went into effect January 1 of 2018. And when we take a look at that law was passed without a 60-vote Senate majority, which means that at the end of 2025, most of the provisions in that law sunset back to where they were in 2017. With the ridiculous amount of money our government has spent and the additional amount of debt they have taken on in the last 5, 6, 7 years, I can't imagine that anybody will let that happen. So I think, first of all, just to put it in context, in September of 2017, our U.S. government passed $20 trillion of federal debt for the first time ever. And we put out some things saying, hey, in the next 10 years, we might be at 30 trillion. And I remember people saying to me like, oh, you're such a pessimist, that'll never happen. And we got there in February of 22, right? So in 4.5 years, we went from 20 trillion to 30 trillion. And I can't imagine a scenario where tax rates to pay for all of this debt and all of these government programs can do anything other than go up. So therefore, my belief is that the 2024 referendum, the 2024 presidential and congressional elections, while you're not hearing a lot about this part yet, by a year from now, you're going to be so sick of hearing about what's going to happen with tax rates, because whoever comes out of the 2024 election with control of the White House and Congress will be in the catbird seat to write the next set of tax legislation in 2025. And I can't imagine it going any lower than what it is today. So stay tuned. There's going to be a lot. I'm sure we'll be writing about it a lot. I'm sure we'll be talking about it a lot in client meetings and so forth. But it's something that we wanted to make sure you're aware of. So with that, we're right at time at 5 o'clock. Always a lot of things to talk about. And we thank everybody for their attendance. As always, if you have questions about your situation, reach out to me, Nathan, Irene. That's what our team is here for. and we look forward to seeing you again soon. So thanks, Nathan, and everybody have a great night. Thank you.
All right, thanks.